The Apartment Gurus podcast is brought to you by Greenlight Equity Group, an apartment acquisitions and holdings firm co-founded by Carl York and Tate Siemer, host of this show. We offer you the opportunity to be an owner of cash-flowing, wealth-growing apartments without the headaches of being a landlord. These assets are recession-resistant, risk-mitigated, offer significant tax advantages, and are a great alternative to the stock market. Ready to check it out? Go to www.investwithgreenlight.com today to book a personal consultation with Carl or Tate. Again, that's investwithgreenlight.com. We look forward to meeting you. Welcome to The Apartment Gurus, where twice a week, host Tate Siemer brings you deep dive interviews with the wisest gurus in the apartment investing industry. These experts are sure to create game-changing value and inspiration designed to catapult your business to the next level. Be sure to reach out to Tate at www.investwithgreenlight.com for access to his investor portal and Calendly link. And now, here is Tate Siemer and the Apartment Gurus.
Well, welcome everybody back to another episode, The Apartment Gurus. And you know, when you name a show, sometimes when you name a show something like The Apartment Gurus, you have certain people in mind, maybe that, either past guests or wannabe guests, like people that you want to have on the show that are true gurus. And I'm so excited to bring back onto the show Mr. Neal Bawa, the Mad Scientist of Multifamily himself. It is always such a delight to hear from his wisdom and his enlightened, data-driven perspective on so many different things. And we have a really, I think, one-of-a-kind sort of show in store for you guys today in terms of what we're going to get into with Neal. And for those of you that don't know of Neal or don't know Neal's story, first of all, where have you been? But second of all, you can check out the prior episodes that Neal's been with us on, the Apartment Guys originally, and then the Apartment Gurus after the name change. So, sir, thank you so much for being with us today.
You're more than welcome. It's always fun to talk with you, and I'm looking forward to actually seeing you at a conference in less than 4 weeks.
Yeah, here in sunny and yet snowy Salt Lake City. We've had I've been here 23 years. We've had the biggest winter that I've ever seen in terms of snowfall in the mountains. But the beauty of living here is we get a lot of sun in the valley down from the mountains. So, and you know Utah well. I know that you really love a couple of different Utah markets, St. George being a darling of yours that you've talked about a lot in the past. How are, I guess before we kind of jump into, some of the stuff that you and I were talking about before we hit record, which I can't wait to talk about. How are things going for you on existing development projects? I know you've got a number of those in the works. How has things with the market affected those, if at all? And how have things with the market affected your overall business?
Sure. So, your development pipeline is going to have, late stage projects, mid stage projects, early stage projects. So the ones that are early stage that have just gotten to the shovel ready point, we're just pushing them back. It doesn't make any sense for us to take debt at this point in time. We're well capitalized. We usually raise enough money to pay for the land in cash. So we're like, why should I get a loan today at, SOFR plus 4, SOFR plus 5, where I think I can get a loan, 6 or 9 months from now at SOFR plus 3 or SOFR plus 2, right? So that's the thinking. And so if they're at the point where we haven't pulled the trigger on the construction loan, we're just pushing them back. Then we have projects that are in the construction pipeline where our costs have risen. So they're already in construction, stuff that's going on. And we have a variable rate. So obviously, as these rates are going up, SOFR is going up and the spread is going up, it's affecting us. Now, the spread portion is actually locked in. So in many cases, and this is actually part of our discussion today, People are like, yeah, but interest rates are going up for construction loans. Actually, what we're more afraid of is the spread going up. So if I locked in with a low spread on a loan a year ago, and now I'm seeing the interest rate portion of it go up, it's actually less problematic for one simple reason. That interest rate will go up, and then 6 to 9 months from now, it will start to come back down as well. So
Mhm.
I get the I take the hit now, but also get the benefit a year from now. So it tends to be less problematic because that spread is locked in. It's not moving up and down. And I'll
Yeah.
talk a little bit more about the SOFR versus the spread in a moment. And then we have projects that are very late stage. So we're taking some hits on those on the interest side, but we're as long as we don't sell them in the next 12 months, we find that they're not impacted much because we're basically finishing them up and we're leasing them up at this point. And we think that in 2024, we'll have access to much lower rates if we want to sell them. If that doesn't happen, we won't sell them until 2025. So the development market is challenged.
Mhm.
Anyone that says it isn't challenged or there's something magical about development where it doesn't get hurt, the answer is if you position it well, some projects won't get hurt. Like my shovel-ready projects, just the fact that I'm not taking a loan on them, if I'm able to convince my investors, hey, it makes sense to wait 6 to 9 months, then great. Then I'm in a good position, right? So, I can brag about that. But a project that's already in construction, there's nothing I can do about it. My construction costs are going to go up. So development has similar challenges to what we are seeing on the value add side.
Most construction loans, most construction debt is variable debt, if I'm not
Mhm.
uh, mistaken. Have you been affected by that in your projects?
So some variable, some not. So I have, for
Yeah.
example, in New Braunfels project, 110 townhomes, 4% fixed, right? So it's interest only,
Wow.
4% fixed. So as you can imagine, I'm actually slowing down because
Mm-hmm.
the way that particular loan is set up, it goes to halfway through construction and then I have to get a different loan. So I'm slowing construction down so I can get to halfway at a later point. Um, so the the truth is, most loans that syndicators were taking out, even on value add, were floating loans.
Yeah.
So if you look at 10 properties that syndicators bought in the last 2 years, especially not in maybe in the last 6 or 7 months, but before that, everybody was just doing floating loans because it made sense. There was a lot of common sense to floating loans as long as you were getting a rate cap. But nobody really believed that those caps would be hit. So people did buy a rate cap, but they didn't think that the rate would actually go up all the way to that cap or beyond. Well, we were all proven wrong, myself included,
Right.
in that list. And so what has now happened is that the multifamily value add market, the syndicators were driving the market and driving the prices. Even though the syndicators are a very small portion of the multifamily market, they're maybe 5 to 10% of the overall multifamily market, but they were driving it because they were the ones paying more
Mm-hmm.
than other parties. And they were essentially doing 2 year, 3 year flips of multifamily, which other buyers were not doing. They were keeping it for 5 or 10 years. So the syndicators were more active in the market, even though they were a smaller component. And so everyone was using floating rate debt. And I think that everyone that was using that is affected. And that's why you're seeing volumes of multifamily, sales volumes have just completely cratered. I saw one report, which I'm a little skeptical about, which said, as of if you compare to 4 quarters ago, volume's only 22%. So
Wow.
78% down in volume. And that's what we're seeing.
Wow. Yeah. This whole this whole issue of spreads in the debt conversation is one that you very astutely pointed out before we got started really doesn't get talked about very much and is is not in the everyday household vernacular of the syndication space. And I think you know it is a very appropriate time to for all of us to really understand spreads and the implications on deals and timing your deals and timing not timing the market but knowing when is a good time to buy in relationship to spreads being good. uh Neal, talk about that. And what should we know now in today's market about spreads and, as you call them, risk premiums.
Absolutely. So, um, firstly, you said it right. If you understand that debt is made up of two components, what the Fed does, and then a component on top of that called the spread or the risk premium. If you understand both of those and how they move up, how they move down, what happens, what has happened in the past, it gives you an advantage, especially in 2023. So 2022 or 2021, it may not have given you as much of an advantage, but in 2023, it gives you a tremendous advantage because it makes it very obvious when you should be buying stuff, right? So let's talk about the different components of that. So there's essentially two different kinds of debt that you can get. There's fixed rate debt and there's floating debt. When you're looking at fixed rate debt, most people don't want to buy properties with fixed rate debt. I don't want to buy properties with fixed rate debt. Tate doesn't want to buy them with fixed rate debt because it has downsides. Even though your interest rate is fixed, the problem is if you want to refinance it 2 years from now or sell it 2 years from now, there is a very, very large financial penalty to get out. Yeah. Right. And this penalty also varies from loan to loan and fixed. There's a couple of different types of fixed rate debt, but it's very painful to get out in 2 years or 3 years. And we've all been getting out in 2 years or 3 years because the market's given us windows to get out. And that's why our numbers look so good and our investors are so happy. So the earliest you can really get out when you have fixed rate debt is 5 years from now, but even then the penalty is pretty high. 7 is a better number, so you have a smaller penalty to pay. If you get out 10 years from now, then you don't have any penalty. So what fixed rate debt does is basically locks you into a property for a minimum of 5 years, most likely for 7. And so people don't like that. Investors don't like that. So people go in for floating debt. And obviously floating debt, the challenge is that the debt could go up, the rate could go up, rate could go down. But what most people don't understand is that floating debt actually has two components, right? You've heard that when the Fed raises interest rates, your mortgages go up, but you probably also heard that they are not directly correlated with each other. So I'll give you an example. So in late September, the 30-year fixed mortgage rate for single family homes, so I'm going to go to single family and then come back to multifamily, briefly touched 7.37%. So that was the peak, right, of single family prices. Now, today, here we are in mid-February. Between that time, that when the rates touch 7.37 and today, the Fed has actually raised interest rates by either 0.75 or 1%. So wouldn't you think that if it was 7.37 back in September, it should be 8.37 today? So the question is, where is it today? Well, it's 6.5. So the Fed has raised interest rates 2 or 3 times since that peak that was reached, but interest rates have gone down, right? And you go, why is this happening? That doesn't make any sense to me, right? And the answer is that's because any mortgage, whether it's a 30-year fix for a single family home or floating debt for a multifamily or even actually fixed debt for a multifamily, it has two components. And the first component is called SOFR. You might as well call it the Fed funds rate because SOFR, S-O-F-R, is very closely tied to the Fed funds rate. It usually tends to be a little lower than the Fed funds rate. So when the Fed is raising interest rates, what are they doing? They're raising an internal rate. They call it the Fed funds rate right now, I think. And the Fed funds rate is actually not a number. It's a range. So today, right now, I think it's 4.75 to 5. Right, so that's the range, and most people look at the lower range, by the way, when they talk about it. So 4.75 is where the Fed funds rate is today, and SOFR is a little bit lower than that. So right now it's I think 4.55, something like that. So SOFR, that piece is effectively the Fed funds rate, just a little bit cheaper. And so if the Fed funds rate goes up by 25 basis points, the next day SOFR is going to go up by 25 basis points. So it tracks directly, and so this is how the Fed is affecting your lending costs, right? But on top of that, there's a second piece, and that's the piece that most people don't understand, especially in 2023. If you don't understand that, you're going to lose a lot of opportunity, and that's called the spread. Now, most people know that there's a spread, but what most people don't understand is how does the spread move up and down? What does this spread actually mean, right? So the spread is a combination of a bunch of things. Number one, it's the banks charging you their fees and some of their profits. Not all of their profits, because even the Fed funds rate component, the SOFR component, has some money for them. And then on top of that, it's about their risk profile. So basically, that spread represents the risk premium. Now, banks don't quite know what is going to happen in the future, right? And they know that once they give you a loan, that SOFR component that's on the bottom is going to go up automatically. If they give you, a floating loan, if that SOFR component, the Fed funds rate component goes up, well, you'll be paying more. So it's not any money out of their pocket. But the portion that they're getting, their spread, is mostly their profit. Well, they want to be very careful with that, because when they take money from someone else, they borrow money from someone else, they have to borrow at a certain cost. And they want to make sure that they don't end up upside down if the market becomes more volatile and that spread component goes up. So guess what they do? They basically think of the worst number that they can imagine given the current scenario, and they stick that in as the spread. When things are not volatile, when the market is very stable, the spread can drop. It can drop all the way to 1%. Okay, and that's pretty much where it was, pretty much where it is for single family right now, probably 1.5%. So you take the SOFR component, 4.5%, you stick, 1.5% on top of that, 6%, you can get lots of 30-year rates. The rate that I just gave you, 6.5, that is the average 30-year fixed rate. But there's plenty of people offering 30-year fixed rate at under 6%, usually internet-based companies. You can get 5.5% fairly easily. So bottom line is, on top of that 4.5%, which is pretty much fixed because that's what the Fed's charging, you're only putting in 1% on top of that, and you can get a 5.5% mortgage today. So the spreads there are down today, where 5 months ago in September, the spreads were really high, even though the Fed funds rate was lower. So what was the difference? The answer was that all of the banks 5 months ago were in the worst case scenario mode. They were just basically saying, I need to charge the maximum spread I can get away with, because I don't know where the Fed's going to go, how long they're going to go. And today, in early February especially, people are like, we think we know that the Fed is going to end its raises in either March or May. That's a very common number. I think it might be June. But either way, they're not going to go up crazy numbers from here. It might be 0.25 more in March, 0.25 more in May, and maybe 0.25 more in June, right? That's 75 basis points. They were raising by 75 basis points every month last year.
Right.
So now they're slowing down radically. And so people are much more comfortable with, that spread being smaller. Right? So now you understand that the components are different. Now, when you're getting a floating rate for a multifamily property, so you know that if the Fed funds rate goes down, which is probably not going to do this year, but next year, you'll get a benefit anyway, because you have a floating rate, and if it goes down, you'll get a benefit. If it goes up, you'll get a benefit. But what about the spread? Well, when you lock in your loan, the spread is decided on that day, and it doesn't change. So if you buy a property today and you have a spread of 4% on top of SOFR, well, until you refinance this property or sell it, you're stuck with it. You're stuck with it. And today, the spread is the highest that I have seen it at any time other than the 2009, 2010 timeframe. It's extraordinarily high. And even though you have a floating rate, you're going to get stuck with potentially the highest spread in history, short of 2008, 2009. That's where you stand today if you're buying a multifamily property. So doesn't it mean that it should be extremely important to you? You should be really paranoid about the fact that what does the spread look like in 3 months or 6 months, right? Because the spread goes down pretty quickly. I just gave you an example of single family, how the spreads have crashed, because now everyone thinks they know where the Fed is going, and so the uncertainty level is down. So even though the Fed funds rate is much higher than it was 5 months ago, interest rates are much lower on the single family side. Single family is very competitive. There are thousands of lenders. So the spreads tend to collapse quicker. The risk premium tends to collapse quicker and adjust to the market much faster. And also ziggy-zaggies a lot more. Multifamily has less lenders, so they tend to be slower to bring the risk premium down. They don't tend to ziggy-zaggy as much based on just one piece of news about the Fed or about the economy or about inflation. So you get a more steady fall over time. So I think today, if you're interested in multifamily, you need to know the answer to one big question. Where are the spreads going in the next 9 months?
Well, sir, and
I set it up, the next question
great
here.
setup. Do I even need to ask? No, I obviously, well, can I guess first?
Yeah, please.
It seems to me, obviously, if we've hit a peak, and it sounds like we actually hit a peak in the fall
Hmm.
and have seen a little bit of recession. Have we seen any recession at all in the multifamily space?
Um, I don't know. I mean, I think housing is in a recession. I don't know how much of that is true for the multifamily industry.
No, I mean, as
Um,
far as sorry, receding of the interest of the spread, I guess is what I'm
we
saying.
we have not seen the spreads recede in the
Okay,
multifamily space because
sure.
the multifamily space takes longer to adjust
Yeah.
to good news than the single family space takes. And from what I've noticed, for reasons I don't understand, it seems to take 3 or 4 months longer, and
Mm.
I think it should react faster, but I haven't seen that happen. So to me, today in Feb, the spreads are almost as high as they were in November or December. They may be a
Yeah. Okay.
tad bit down, and so there's some early indications there. So yes, I agree with what you were in the direction that you were going in.
So yeah, it's
You
got to
know,
it's got to almost be baked in at this point that that the spread's going to come back down in the multifamily space.
I believe so. So
Yeah.
bottom line is the spreads are likely to come down. Now, here's the big question, right? And this is where people get this so wrong. I speak to people at conferences and they're like, yeah, but we don't think that, we're being conservative. The Fed's not going to drop rates until November or December. Oh, I agree with you. I think I'm in the right boat with you that I don't think that the Fed has any needs to drop interest rates, in June or July, which a lot of bullish people are saying. I think it's just nonsense. I think the Fed drops when they want to drop, and it's probably going to be in Q4 sometime. But the question is, when you apply that to spreads, you're being outrageous. It's absurd because the
Hmm.
spread has nothing to do with the rate that the Fed is using. It has everything to do with the market's interpretation of future hikes.
Hmm.
It's speculative in nature, right?
Yeah.
So, as with all speculation, you're either bullish or bearish. So until last month, the vast majority of people that make up spreads in the US were bearish.
Right.
Today, the vast majority are bullish, right? They're bullish that they know where the Fed is going to, so they don't have to have spreads at 4%.
Hmm.
Right? Now, there's other factors that affect spreads. One of them is liquidity. The Fed is withdrawing liquidity from the marketplace. So as the Fed withdraws liquidity from the marketplace, there's less places where you can sell debt. So that also affects the spread. But we're also beginning to see those markets start to stabilize. So we're beginning to see private equity funds come in and basically take a bigger chunk of the market as they get more bullish. So it's a problem that basically gets resolved. We're in a free market system. When people start getting bullish, they're like, yeah, I'm going to bring in my money and I'm going to put in some money and I'm going to become part of the solution. I'm going to become part of the liquidity. And so that problem starts to resolve. And probably that's why multifamily takes longer than single family, where it takes a while for that liquidity to come back into the marketplace once people feel better about the marketplace. So let me give you an example. I mean, this is just an example. Every month, what I'm about to say changes because I change my numbers. So I have a spreadsheet that's called the Grocapitus Interest Rate Model version 4. So obviously changed many times. And in there, I've got SOFR, I've got the Fed funds rate, and as you can imagine, the Fed funds rate is really the SOFR, the same thing. And I've got some predictions of when the Fed funds rate hits its maximum. So in my predictions, we go in March to 5%. So we're at 4.75 now. So we go to 5 in March, we go to 5.25 in May, and then we sit there. And we basically sit there until November when we start going downwards. That's my predictions. So as you can imagine, SOFR is pretty much tracking that because SOFR is the Fed funds rate, only slightly cheaper. But the spread in my spreadsheet says in January, the spread is 4%. And again, everyone's loans are different. So some people are going to see spreads of over 4%, some are going to see under 4%, but 4 is a pretty common number, right? That's the common spread number.
Hmm.
Guess what? In February, this month, I'm seeing that reduced to 3.75. Next month, 3.5. Next month, 3.25. Next month, 3. And then it's going to sit there for a while. Why? Because the Fed funds rate is going to sit there for a while. Because once the Fed reaches their peak, they're going to let things run for a while. And so this is going to sit there for a while. And then it starts to reduce again. Eventually it goes to 2.75, then it goes to 2. So the big question is, why would you want to today buy a multifamily property with a spread of 4% or 3.75 When 7 months from now, you might be able to buy it with a spread that's 1.5% less. Remember, once the spread's locked in, it doesn't change for the duration of the property unless you refinance it 2 or 3 years from now. You're stuck with that.
Right.
Why would you want to be stuck with it when 6 or 7 months from now you're stuck with something much lower?
Man, this is awesome. I wish we would have had this conversation about a month and a half ago, though. We've got a situation where we're in a loan that bears resemblance to some of the things that we've been discussing and has quite a spread to it. And we're actually, as of this morning, kind of relooking at some of the other options that we might have. It's particularly in the way of creative financing with either assuming or wrapping the seller's existing note, existing debt piece, and going that route. Which to me, based on what you're saying, I'm just kind of, I guess, extrapolating that as far as any sort of, commercial debt goes, you got to be pencils down at this point, aren't you?
I'm being forced to be pencils down because here are my two options. I can go for fixed rate debt and offer a small amount of cash flow to my investors, and then I'm locked in. My investors are locked into that property for 7 years, maybe 5, but most likely 7. I don't like that option. Or I'm going to go floating rate debt, and if I buy it today and my spread is locked in 60 days from today, I have no cash flow for 2 years. So I have to tell my investors, please invest with me, give me money, even though I'm going to buy a property that's going to have no cash flow, right? How do you make that happen? My investors trust me, but they're looking for cash flow. So it's very difficult to get cash flow on these existing properties. Yeah. So I'm being forced to be pencils down, but I'm going to pick up my pencil and I'll tell you why, right? So I want to go into contract in April. So right now we're talking, it's mid-Feb. I want to go in contract at the end of April. And I want to write a contract that keeps me in contract, give me options to be in contract from the end of April, let's call it May 1st, all the way to October. Because I want to see that spread go down. And if I'm really lucky, I might even see the Fed funds rate go down once or twice. I'm not banking on the Fed funds rate going down that early by October. So this is one of those cases of, just close the damn property on the last day that you can, keep it in contract for a significant amount of time. Mm-hmm. So when you're looking to put a property in contract at the end of April, beginning of May, I'm not going to be pencils down for much longer, right? Because I have to start underwriting on March 1st to put a property in contract on April 30th. Mm-hmm. Mm-hmm. Now you might say, why don't you just wait a little bit longer than that? Well, there's a downside to waiting longer. Let's say I wait until August. Wouldn't by then everybody know that the spreads are going down? Right. And if the spreads are going down, guess what happens in a highly competitive market? If the spreads go down, people can afford to pay more for the same property. And so now there's people that come back into the marketplace and they bid up the price. And so the price starts to get bid up again. And more people are putting more hard money down and things like that. So there's only this window of time where you get the highest cap rate that you can get, mm-hmm. combined with the lowest interest rate if you can stay in contract for 6 months and then close at the end of October. Now, I could be completely wrong. And at the end of October, the spread is just as high as it is today. Possible, very possible. I think that I have a pretty good chance, though, of getting that benefit and getting that improvement.
Mm-hmm. Right, because you can see it's a trend that's pretty trackable, and it's directly tied to volatility, or it's almost a measure of volatility, it seems like, in a way.
That's the spread is mostly a measure of volatility and of liquidity. So it's a measure of two things, liquidity and volatility. Liquidity doesn't come back as quickly as volatility goes down. Now, let me give you an example of why I think volatility is down. So the stock market uses a fear and volatility index called the VIX, V-I-X. The VIX has become shockingly stable since the beginning of this year. I mean, shouldn't it be very high right now? I mean, look at interest rates. It should be very high. But the
Super, yeah.
VIX compared to 6 months ago is extremely low, right? So people's fear on the stock market side is going to sooner or later reflect the fear on the other side, right? So that fear level is definitely going down, and we're seeing that fear go down. And I think as that happens, you should see the spreads come down. And again, if they don't come down much, like hugely, maybe I'm wrong, they don't come down 2% over between now and the end of October. Maybe they come down 1%. Isn't that good? 1% on a $25 million loan is $250,000 a year of cash flow.
Yeah, it's huge. Yeah, yeah. 1% in a underwriting model can really sway things a lot, as many listeners know. Well, I want to switch gears. This whole thing about spreads is just fascinating, and there's some big takeaways. I mean, if nothing else, everybody should know when they get a term sheet from a lender, what they're looking at and how things might be changing, in terms of rates and spreads. And, if you were to wait to lock, it might, or to buy, it might do you very well. Is there kind of a Google of tracking spreads, Neal? Like where do you watch this stuff?
No, there isn't, because unfortunately the spreads are by lender, and there isn't a repository of information. What I do is actually shockingly manual. I call my friends every once in a while and say, "Hey, are you getting a loan? What's your spread?"
Okay.
Right?
Okay.
I call my lenders and ask them the same question. So I don't know of a way to optimize that yet. I'm figuring it out. I'm the mad scientist. I will figure it out.
Yeah, you're on a mission. I love it. I love it. Well, great stuff on that. And so hopefully listeners, you got a lot out of that, and how important it is to understand your debt right now. It's absolutely essential. And savvy investors, your savvy LPs, your savvy co-GPs, it's, if you will, like they're going to want to know every last little bit about your debt. So you need to know it and understand it and know how to maximize the opportunities in the market. All right. So first things first, you think, just based on what you said, you think possible 3/4 of a basis points, 0.75 basis points more in the market is what you're seeing?
Yes.
75 basis points, I mean.
Yep. So March and then May. Actually, I'm sticking for the moment with just March and May, so that's 50 basis points more. But it's possible that there may be a final 25 basis points in June. So that sort of depends on where job numbers come in. We obviously, the Jan job number was completely insane, and
Right.
I don't want to even look at that number, and even I have trouble believing it. So I'm just going to wait to see what Feb numbers come in, and maybe it was just a one-off weird number. I mean, it was 517,000 jobs gained in a single month. Is in most times, not in the middle of this kind of Fed activity. In most times, is a full-on party, right? Champagne bottle, corks popping, that sort of stuff. So I want to see where that goes. But if the Feb jobs report comes in over 200, then I'm going to add in a quarter point in June.
Okay. Yep. All right. So going into this next chapter of our market and our business, you're of the opinion that our industry, meaning the syndication industry, is largely ignoring some really key stuff, and therefore missing, amongst other things, missing some opportunities. But I'd love to hear your thoughts on what isn't being talked about right now that you think is super important, stuff you see coming down the pipe that we need to be prepared for, and anything else you think we should know.
Absolutely. Well, the first thing I want to mention is this. If you're a syndicator and you have 10 properties, and like most syndicators, you're using floating debt. So I'm going to assume that you're one of the more common syndicators that use floating debt. I'm one of those, by the way, so I'm not suggesting that I'm any better. Yeah, and you have 10 properties. You've got to have, at this point in mid-Feb 2023, at least 4 of them that are bleeding. They're losing money, right? So I don't know of anybody that is not at least at 40%. Now, if you're the kind of syndicator that bought these properties 4 or 5 years ago, no, you're not typical. So I don't want to, say that's you. But if you're the kind of syndicator that was heavily purchasing properties in 2021 and 2022, then yes, I think the 4 out of 10 number applies. So doesn't that mean that thousands and thousands and thousands of multifamily properties across the United States are not just bleeding money, but bleeding large amounts of money? My definition of large amounts of money is $100,000 a month. Right? Because if a property is bleeding $40,000 a month, you have a lot of simpler options. You can use reserves. You can, put in your personal money, which syndicators do. Ethical syndicators will put in their own money. But once it hits $100,000 a month, that number becomes so big in a year, $1.2 million more, that your options become very limited. And so today, what I'm shocked about is I go to the industry conferences and there aren't 2 or 3 or 4 sessions on things like best practices of capital calls and cash calls, how to bargain with your bank, and what are the conditions that a bank will bargain in to change your interest rate. What is recapitalization and how can a recap expert help you prevent a default? What does the whole process of you going from bleeding to default look like? How many different ways will a default where a property goes back to a bank affect you as a syndicator and affect your investors? I think these are all extremely pertinent topics.
Yes.
Where are they? I mean, which conference are they being talked about? People are saying this is too early. I think that's bullshit, because when are you going to talk about it? After people have had hundreds of defaults? Wouldn't the industry already be affected at that point of time?
Yeah.
Don't you want to prevent the defaults? Isn't the purpose of a conference to provide forward-looking education?
Yeah. Yeah. Yeah, I agree. I mean, it's impossible to argue with, and with, like you said, it's not that this stuff's coming, it's that this stuff's already here.
It's here at this point in time, right? So note my statement. I said in Feb 2023, for syndicators that were heavily buying properties in 2020, 2021, 2022, 4 out of 10 of their properties are bleeding today. Yeah. Now, it's true that we haven't had a wave of defaults yet, right? But again, once again, don't we all together want to avoid those defaults? They're not good for anybody. They're bad for everyone.
Yep. All right. So let's dig in to capital calls and bargaining with banks, and your thoughts on those two subjects.
So here's this is a very long topic, but I'll try and do it in a summarized version of it, right, in the next 10 minutes. So number one, banks will not change their loan terms, because if they change it for one person, it becomes very difficult for them not to do it for everyone, right? Because now you got new loan terms, they cut you a slack. They have to do it with all of your friends. Now there are some limited exceptions to this rule, but let's just say that they're not the majority of the time. So there's a small minority of the time where certain banks might be able to make a short-term adjustment for you, but the majority won't. So what are the conditions in which a bank actually changes loan terms? The simple biggest answer, there's 2 big answers. Let me just give you the first one because it's so much easier than the second one. If the bank really, really, really doesn't want your property back, and a lot of banks in this environment are not overly worried about that, because in 2009, they didn't want a property back, right? Because the value had fallen so much. Today, the values have not fallen by enough for the banks to worry about it, because if there's 30% equity, then at that point of time, you simply would not be in a position as a bank, if the value had fallen by 30%, that would wipe out all the equity, and now the bank would be in trouble with their principal. But if it had fallen by 10% or 15%, then the bank's still in the black, so they don't worry as much about the property. But there are exceptions to that rule. There's markets where prices have fallen more. There are also properties where there was less equity to begin with. It was maybe 10 or 20% equity. So in those cases, the banks might be more motivated. So let's look at the majority of the cases. They're not motivated, right? Well, in that case, the only exception that I've seen that seems to work is called recapitalization. So recapitalization is the process of adding millions of dollars of new lending or equity to an existing property. And it comes in from private sources. The bank doesn't interact. But in those cases where you can provide proof that you're recapitalizing the property, then there are many banks, not all of them, many banks that in many cases will make an exception and renegotiate things with you, right? And why will they do that? Because now they've got millions of dollars coming into their property. When a property is bleeding, the bank thinks the property is theirs. When the property is making money, it's yours. When it's bleeding, it's theirs. So someone is now putting millions of dollars into their property, right? And so now they're willing to help in that process because in the end, they don't want the property back. Banks are not in the business of running properties. So now something good is happening to the property and they want to make that good thing happen so they can help. Also, if now Tate puts in millions of dollars of recap money into his property and tells his friend about it, his friend calls his bank and the bank says, sure, you do the same thing that Tate did, put millions of dollars more into the property. And if you're doing that, then come back to me and I'll adjust your rate. You see what I mean? Now they don't have to deal with an avalanche of people calling and begging them to change the rate. So recapitalization is a process where a third-party syndicator or third-party somebody comes in and puts more money into your property. And recapitalizations are horrible. They are painful. They're painful for general partners. They're painful for limited partners. But they're infinitely preferable to a default. Because I think that we have syndicators today who have never seen a default. They've never been through this process. They've never done a cash call. I mean, I've gone through a cash call, and I'll tell you this. I would much prefer a root canal to a cash call. Cash calls are insanely painful. And the only reason people don't understand this is because they've never been through one. I have, and it's very painful. So to me, a default is even makes a cash call look like a piece of cake. Because with a default, you now have to put it on every single loan that you get for all time in the future that you went through this default, and then you have to go through a process of explaining it. And for many loans, you simply will never qualify. Your investors will never work with you again, and they'll, the internet being what it is and trolls being what they are, your name's ruined on the internet because they'll go and tell everybody about this. And, you basically your ability to raise equity drops. And then the third part is this. This is the part that I'm shocked about in the industry that people don't talk about or they don't understand. So someone thinks, okay, I bought a property for $20 million and now it's worth 19 million or 18 million because prices have gone down. And if I'm not able to pay for it, I'll return it to the bank and the bank will sell it for 18 million. My investor's equity was only $3 million to begin with. So, or $5 million to begin with. So they'll still get 3 million of their $5 million back. No, you idiot, they won't get anything back because the bank has no legal obligation to sell this property at the market price. The bank doesn't want to spend the next 6 months going through a very painful and public process to get the peak price. The bank only cares about their loan. As long as they can find some rich dude to walk in and write them a cash check for an amount higher, they'll do it. They're not supposed to do it. It's unethical. It can even be challenged in court. It can even be successfully challenged in court. But does it happen? All the time. Right? So you're not going to see a dollar of your investor's money ever again.
Right.
If you let it default. And so the key thing is this. People don't understand that if the property goes back to the bank, they've lost all of their investors' money. This is something that's not known in the industry. Second, you can really not do anything in the last 90 days. So if you're 90 days from shit creek, you're late. You need to act. You cannot get last minute preferential equity, pref equity, or rescue equity into your property. You cannot recapitalize in 90 days. You need 6 months to do that. You need 6 months to negotiate with the bank and hopefully get a lower interest rate. So in this scenario, right, so I'm not seeing enough of these people act 6 months before they run out of money. The property's losing $120,000 a month. Are you $720,000 away from default? So you need to move, right? You need to absolutely move now, and I'm not seeing that move happen. Not enough people are calling. I have a rescue fund myself. It's a pref equity fund that brings in money into properties. I don't feel like I'm getting enough calls. I'm
Yeah,
getting 10
interesting.
times as many as 3 months ago. When I'm computing the number of properties that must be upside down, I'm not getting as many. So either syndicators are very rich and they're going to just plow in millions of dollars of their own money into properties, or we're going to see some really bad things happen in Q2 and Q3.
Mm-hmm. Mm-hmm. So a rescue fund or a recapitalization expert, the third party, obviously those are two different things, but again, is it LinkedIn? Is it where, sourcing that stuff? What's our best bet?
There's no easy answer to that question. I think that brokers would know. So if you've got a debt broker that you worked with 3 or 4 or 5 times, they're probably going to know who these people are. They make themselves fairly obvious. There haven't been any rescue funds in the industry, in the syndication industry and the multifamily industry for about 6 or 7 years because there was no need for them. There was no
Yeah.
actual need for them. Um, so nobody wasted their time creating these funds. So a lot of the funds are being formed. So I know of 3 that exist in the industry, including mine. So there's a couple more. Um, so I don't have a good answer to give you on where do you find these funds. I'm simply pointing out the problem. I'm not
Yeah.
necessarily pointing out the solution.
Solution. Yeah. Well, it certainly is just very prescient, is the best word I can come up with, information and stuff that everybody needs to be thinking about. I mean, like if you've got 10 properties and 4 of them are bleeding, that's nothing to necessarily be ashamed of. It's the reality of the market we're in, and you're not the only one. And you got to do what's best for you and your investors first before you, of course, to keep things at least floating and workable, so to speak. And Neal, you just brought to light some really interesting even though you did point out the problem, you did point at the solutions as well, as far as the recapitalization process, and
And cash calls, right? So, I
cash
mean, a
calls.
lot of
Yeah.
people come to me and have been coming to me for the last 2 months, and the first thing I tell them is, "Did you do a cash call?" "No, I thought you would come in as a rescue fund, so I wouldn't have to do a cash call." The answer is, no, that makes no sense whatsoever.
Mm-hmm.
Because if I go and tell your investors how painful it's going to be for them and how painful it's going to be for you as a general partner, the first question they're going to ask is, why didn't you try a cash call?
Mm-hmm.
Right? So they're not going to sign off
Right.
because this is a PPM change. Those people that are in our industry understand what a PPM change is. It's a change in the investor docs, and only
Yeah.
investors can sign off on that, not you. As a general partner, you really don't have the authority to do that because you're changing the structure of the project. You need
Yeah.
the blessing of your investors, and I don't think that they would ever give it to you without a cash call. So what I'm finding is that people don't even understand this, that it takes 2 to 3 months to do either a successful or unsuccessful cash call before you would want a rescue fund to come in,
Mm-hmm.
right? And where's that time? Where's the time?
Right. We've got just a couple minutes here. I want to honor your time. Any tips on cash calls?
Um, Ask for at least 2 times what you need.
Okay.
Um, and make sure you prepare a presentation for a cash call that is as strong as the one that you prepare when you bought the property.
Yeah.
Just
And
don't show up there and say, we're losing money, here's where we are, blah, blah, blah. No, I mean, you have to sell people on the concept of giving you money when you've got a bleeding property. It's very hard to sell people when
mm-hmm.
you don't have a property and it's all bullish. Now they've seen the property lose money and you still want more of their money. You'd better do the best damn marketing job you've ever done.
Yeah. Well said. Neal, always such a pleasure to be in your presence and get to hear from you. And you're such a unique thinker in this space, and you create so much valuable wisdom for all of us. And super grateful for you coming on the show. Any kind of final thoughts for us as we close things out?
Nothing's changed on the demand. Long term, multifamily is a great asset to buy. Let's just figure out how to get through the next 12 months.
There you go. That's it. That's it. Awesome stuff, Neal. Thank you so much. Really appreciate you. And you're a great friend of the show. I think this is number maybe 4 that you've done with us. So really appreciate you. And listeners, really appreciate you all. Oh, by the way, before we get into that, you can find Neal at his new company, You Grow, and You Grow Forward. So it's UGRO forward.com is where you'll go for that. Neal, any other? Of course, there's Grocapitus. Anything else that you'd like to mention and ways that people can interact with you?
I think the best way that I like to mention is Multifamily University. So if you go to multifamily followed by the letter U, multifamilyu.com, we have 20 webinars in there. As you can imagine, a webinar on cash calls is coming. So I'm working on that. We tend to focus more on limited partner concerns rather than general partner concerns. So there's more content there for LPs. But the one that we just did, Real Estate Trends, was actually a phenomenal webinar, and 2,600 people registered for that webinar. I think we've had 1,400 watch it so far. So it's recorded there. It's free. All the content in multifamilyu.com is free. There's no subscription. There's no upselling. There's no educational, $10,000 or $100,000 educational product. It's just completely there for community engagement. So multifamilyu.com is probably the best bet.
The last webinar, listeners, is must-see material. The basically Neal's annual trend and forecast, and goes through his top picks on markets and best markets to invest in, which amazingly we didn't get into today at all, because I'm just always fascinated to hear from you on that. But if you want to hear what Neal's favorite 2 cities are for investing in multifamily space this year, go check out Multifamily U and look at that. Is it your most recent webinar that's posted?
Yeah, I think it'll be easy to find. Just look for Real Estate Trends in the recordings.
Trends. Yep. Got to see it. We won't say anything about the city in Georgia and Florida that you like so much. So we'll leave them in suspense. So Neal, thanks again, and listeners, thank you. Love you guys. Really appreciate you being on board. Hopefully, man, I've got 2.5 pages of notes here from this, and just invaluable time with Mr. Neal Bawa. So hopefully you all got a lot out of it, and we will see you guys on the next episode. Take care, everybody.
This has been the Apartment Gurus with Tate Siemer. If you enjoyed this episode, be sure to subscribe and leave a rating and review on your favorite podcast platform. To contact Tate, go to www.investwithgreenlight.com for access to his investor portal and Calendly link. He loves to hear from you and thanks you for being a valued listener. Just a reminder that you are the guru. See you on the next episode of the Apartment Gurus.